Hello, everybody. Welcome to Insights 2023 Halftime Insights. So, we like to highlight at the beginning of each year kind of what's going on, what's to be expected for the given year, and then middle of the year just to check in to see how everything's going. If there's been any market changes that we need to discuss, and just talk about the landscape as it exists because time moves so quickly, and the markets and economics and all that moves incredibly quickly as well. So, just wanted to provide some updates and a few slides along the way just to share what we've been seeing going on so far. And then we'll get this all out to you and answer any questions that you have. All right. So, we've got our disclosure here. So, I want to talk about the first half of the year, a little bit about the second half, kind of market forces and things that are driving what's going on here in the future, where we're at now, and then what we think might be ahead here for the second half. So, first part of the year here, we've seen a number of events, but overall, we've seen the market, of course, go up. And so early in the year, we had December CPI went up a little bit more than expected. So CPI is the Consumer Price Index, and that's marking basically inflation. And so the big thing that's been driving these markets last year and this is the movement of inflation, because that's then driving Fed policy as to whether they're raising interest rates, lowering them, or keeping them right where they're at. And so the higher interest rates began to create a little bit of fracture in the economy, something we hadn't seen yet. So basically, what the Fed's been trying to do is raise these rates to slow the economy down. Well, in March, we saw our first big bank collapse that we've seen in a long time with the Silicon Valley Bank. As we learned more about that institution, we learned that they had a lot of crypto exposure, a lot of concentrated deposits. It was a bank very different than the Iowa banks, and we did a video on this you can see on our YouTube channel as well. But that then caused everyone to believe that, oh no, is this a regional banking crisis? Is this going to create a lot of contagion into the rest of the big banks? And so far this year, aside from a few minor occurrences, that's not been the case. Then in April, we saw GDP, or our gross domestic product, continue to rise. So again, the Fed's trying to suppress some of this activity so that inflation doesn't keep going up. And then all of a sudden in May, inflation began to cool. So as many of you heard from me last year, I was a little frustrated that the Fed wasn't giving their actions any time to work. If they weren't seeing immediate data changes, they were just raising at a very heavy clip. Early in this year, everyone believed, and a lot of consensus views were that this was going to tip us into a recession. And there was varying degrees as to what degree it would be, but that it was definitely coming. Well, we are now into July, halfway through the year, and we have not had a recession. In many cases, we don't know that we've been in one until later. So we might find out later that I'm wrong, that we have been in a recession or a mild one. But based on what we're seeing from the economy and what we saw from the cooling of inflation and these GDP increases, so far so good. And then as we got into May, we saw the debt ceiling issue come along, and many of you reached out about concerns about this. Is what does this mean to the markets? As you can see, it was a big political exercise, and then the markets begin to tick up even from there. So it's been a very strange year in the disparity of the market. So this chart that I put together shows the NASDAQ, which is the orange line at the very top, compared to some of the other indexes that we use. Things like the Dow, things like the S&P 500, the bond market, small companies, all of that. Well, the Dow components only did about 4%, but the NASDAQ did over 35. And the reason is that's composed of the big technology names, your Microsofts, your Apples, Meta, Google. They have been by far the big winners. But I also ran a chart that showed if you'd been invested in those companies at the beginning of 2022 and held them through right now, you would still be down about 8%. So even though they've made a big recovery here, they still haven't recovered from what we said could be a heavy risk factor last year as rates went up. And sure enough, they really took a dive down. But as you can see, they've begun to work their way back up. But it's also showing that it's all heavily rated in just this area. And we have a better chance of doing well with more stability by diversifying and by staying active in other areas, not just in big technology. So early in the year, everybody puts out their forecasts, and I love these because we always get to go at this point of the year and make fun of them. So that's exactly what I'm going to do now, because as of the end of May, we're at almost 4,200 on the S&P. We're even higher now into July. And as you can see, almost all of the forecasts were somewhere around 3,800. So no one expected the market to go up. Everyone expected a recession. Many of the big firms were talking about earnings recession and earnings being suppressed. And that may very well come to fruition. But so far this year, they've been dead wrong. And it just goes to show that the consensus views aren't always the ones that we want we're going to make money at and or do ourselves best for our financial plan by following. All right, so what's coming up there in the second half? So we are beginning to see earnings as they've ticked up. The market has followed along, and this has been a lot to do with, again, the technology companies, but other ones like the financials that just released recently are doing pretty well. Energy is relatively stable, that market right now. And then consumer staples, things that we all spend money on, that's continued to do well as well, because what's happening is inflation is beginning to moderate. And so if everybody that wants to can get a job, and if inflation is going down, that creates a good environment for people to spend money. And if they're spending money, that's what's going to keep the economy moving. So while this chart back here that I showed shows that we are beginning to see inflation get suppressed, come down a little bit more, or at least stabilize, what we're seeing here is that there's a lot more job openings than people that can fill them. So the unemployment rate is low, but job openings remain high. Certainly in central Iowa, we're seeing the effects of this, where companies just can't hire the people that they need. And the quality of service, the quality of labor it's apparently seems to be diminishing. And so as long as people that want a job can get one, they're going to be out spending money. It's going to keep the economy moving, probably going to keep inflation up a little bit higher. So while the market has a big expectation for inflation to come down and interest rates to potentially come down, the markets are showing something different, because what they're seeing is more of a straight line with inflation where it could stay right where it's at. So where are we now? Inflation has been sticky. We've been seeing rates, or those prices continue to go up. It shows in different areas like construction costs and things like that. People are less likely to move these days because the interest rate to go buy a new home is much higher than it was even just a year and a half ago. Everybody said that this was the most sure recession of all time, but again, we haven't quite seen that quite yet. And earnings continue to surprise. Companies continue to do well. They're forecasting that they can continue to do well. So what are we looking at then for the second half of 2023? For the first time in 14.2 years, we've begun to see developed markets outside of the United States begin to do well. So as you can see in this chart, the purple represents developed markets overseas. The gray bars represent United States outperformance. So we have been the best block on the house for a long time here, as you can see. Well, now Japan is coming out of a huge economic malaise. Some of the other nations that aren't as dollar dependent have also seen some growth. Other parts of the world are still experiencing inflation too, but their prices and their stocks and their prices of their goods were lower than ours, and they've been able to benefit from that. So this is a trend that I think could continue, and one that I think we should all be taking advantage of, which is diversifying ourselves overseas where we can. We'll still be U.S. overweight and remain that way, but perhaps adding some cash into these parts of the markets, or as we rebalance, adding into some overseas stuff would make some sense. All right, so here we can kind of see all the forecasts that everybody has, and all of it basically says that we're expecting GDP and inflation to probably to moderate, where they'll stay kind of where they are, and then unemployment also to stay relatively low for now. So last I read, we had over 6 million job openings and only about 2 million people that could actually fill those jobs. So if the inflation, or if the economy did begin to eke back a little bit, it would allow that unemployment rate probably to tick up some, where there'd be a little bit more competition for jobs than there is right now. And then by sector, we're seeing that a lot of the expected earnings growth by each is coming in a little bit lower than expected. So they've been cut for certain areas, and it depends on the area. Consumer discretionary, where people may not go out to eat as much if there is a recession. Technology spending, banks have come down a little bit as well. So while we're seeing some changes here, we're seeing big growth in industrial companies. So your big producers and manufacturers are beginning to do well. Consumer defensive names like Walmart that everybody flocks to when prices are down, or Dollar General, you're beginning to see all of those percolate as well. So this rotation will likely continue until the market can figure out where the next trend is going to lead us. And then, like I said, the flexible CPI and the sticky CPI. So the flexible is things that can change all the time. The sticky is things like housing that remains relatively high. So we're seeing the stuff that's somewhat more sticky begin to come down. So we're beginning to see rents in some markets begin to moderate a little bit. A few more vacancies and stuff. So there's competition for tenants because that part of the market's been so inflated. And so that's beginning to be a big change that we've noticed in the markets as well. So the Fed meets again, as I'm recording this, it's July 20th. So next week they'll meet again. The expectation right now is that they will raise rates, possibly a quarter of a basis point again, and then the expectation is that they'll put on the brakes again. So time will tell. We'll see how that goes, but that's the expectation right now. Last year was one of the most dynamic years in the bond market where we saw interest rates go up and then bond prices come down as a result. And so for many of us, that was a kind of a shock and not something that we've been used to because we've seen for so long that those interest rate dynamics were just coming down, interest rates going down for over 40 years. So all of a sudden now we saw rates go up and a lot of bond portfolios go down 15, 20, 25%, depending on the type of bond. So that's also begun to moderate. On that first chart that I showed, the bond market's up about 2-3%. So if rates stabilize from here, bonds should do fine, and we can make 4, 5, 6% on our coupons now, which isn't something that we've been able to do for a very long time. If rates begin to go down, if we go into a recession, the Fed begins to push off and actually begin to lower rates, then bond values will go up. So I think those longer term duration bonds, those longer term treasuries, might be a place to consider also for an investment opportunity because they'll have the ability to benefit from that kind of change and also pay a little bit higher rates than they have in the past. And if stock market volatility begins to really percolate because there is interest rate changes or there is recession, people will pile into treasuries also. So that dynamic could begin to at least moderate, perhaps actually trend the other direction, and we want to be prepared for that. So okay, so let's move into the next half of the year and what's remaining. It's kind of what do we do? Is there anything special that we need to get teed up for or get ready for as we move into the second half of the year? And no surprise, I'm going to say that we need to stay focused on fundamentals. And this chart's busy, but what it shows is what part of the markets has done the best in any given calendar year. The colors change every year, as you can see. Some years it's bonds, some years it's stocks, some years it's big companies, some years it's small. And so what we try to do is invest in a portion of each of these so that we can smooth out those returns and get you what's in the white box, which is that asset allocation return. So just like I don't think it would be prudent to take big bets on big tech just because it's gone up so much. We want to be participating in that, of course, but we don't want to overweight in an area that's overpriced and potentially take a big loss. So you can see like in the 08 and 09 years how painfully low some of those markets can go. So this just shows that by diversifying, we stick to those fundamentals, we have the best chance for success, especially here in the second half of 2023. A lot of attention being paid right now to artificial intelligence. And I like this chart because it kind of shows what was going on in the economy in any given time. So back in the 70s, it was a big talk about gold. And then what was going on in Japan. Then it moved on to the internet in the 1999 to 2002. And we all remember how that bubble came to fruition and popped and caused a lot of pain economically for a lot of folks. Then we've had housing in China and biotech and then the big stocks. And then the big driver of these technology companies doing so far this year is the boom around artificial intelligence. And so I've spent some time on artificial intelligence. I sent out a newsletter about it here recently, and we're still watching it to understand how it works and what ways it may benefit investors and what way it may benefit our economy, what ways it may benefit us as a human race. And so there's a lot of really interesting tools. I've tried a few of them. I use them for some of our writing and stuff now because it can help fill in blanks and get the thought process started. So how this comes out to fruition and how it benefits companies with more efficiencies, that's what the market's trying to sort out. And so we'll all be talking about this in the future. Remember when AI came out and when it was such a big deal back there in 2023? We'll see what that means here in a few years. I remember when the internet came out and everybody told me there'd be no more banks. All banks will be on the internet. There'll be no more banks on the corner. Well, I was just driving down Ingersoll yesterday with Will, and there's about 10 banks just along that street alone. So looks like they're still alive and kicking. So we'll see what this means. And just to wrap things up, the United States gets disparaged a lot in the news, and it's a country that's divided, and certainly all of that's true. But even though we have our problems and all that, we're still the most productive nation in the world. And this is the amount of production that's responsible from each person in the country. And the United States is still the leader in this area as of 2021. So while we have our problems and while we want to definitely diversify outside of just the United States, we're still the most productive nation and one that we want to keep a lot of our investments and things focused on. So as of now, we're still productive. We'll see what it looks like over the next 10 years as China and India get stronger and stronger. Hopefully we can all band together and turn that story around. So thank you all so much for being here today. And if you have any questions, please reach out. Thanks.